Welcome to the Daily Update, where I'll go over the action in the market for Monday, November 20th, and then we'll see how things look for Tuesday, November 21st. We had kind of a surprising up day. We broke out a little bit to the upside. Things are still showing some improvement, but at the same time, we're still getting overextended to the upside. We are seeing a real drop-off in volume as the market goes into holiday mode, but for right now, we're seeing a lot of improvement. We're not really seeing an awful lot of strength at this point when we look at growth versus value, and I'll show you those charts. But for the most part, the market's really hanging in there. We're not seeing an awful lot of profit taking. We'll see if this can continue throughout the week, or are we just going to chop more or less sideways? Let's go back and talk about what happened. Right at the open, we did have a higher open, and prices rose above R1 at 45.23. We got up to R2 at 45.32. We actually went all the way up to R3 as the day went on. This is not usually calculated in what I put on the chart, so I have to calculate this myself. That's because Friday's session was so narrow that it's not hard to get to these R levels. But R3 was at 45.52, and we closed slightly below R3. We were up 0.74% on below average volume, as it seems like things are going into holiday mode. Now, Tuesday might be the exception to that because we have some economic reports coming out. We have the FOMC meeting minutes that will be coming out, and the market may want to have a chance to react to that. The technicals are positive in the short, intermediate, and long term. We're turning more positive. If you watch the weekly video, we're looking stronger there, but we are overextended in the short and intermediate term. Now, there's two ways to look at that. We're due for a pullback because we've gone up too far too fast, or if there's good momentum, the market may consolidate sideways for a bit and then get set to go higher. We're not really seeing any real signs of weakness at this point. That could develop at any time, but it's just not really showing itself that evident at this time. It's about inflation, interest rates, growth concerns, and what did the Fed say in the FOMC meeting minutes? Even though there's a lot going on concerning Israel, it's kind of dropping out of the real news cycle. So we're not really seeing the market reacting to what's going on in Israel right now, but that's still going on, just like the war between Russia and Ukraine. That's still going on too, even though you may not be hearing about it as much. It's more of the reactions that are going on in the US that's getting a lot of press these days. So it may not have as much of an impact on the market, but of course, something big could happen and that could change at any given time. Some comments that we can make: the mega caps, the mega CPAs. Yeah, if you're an accountant, good for you. You did outperform on Monday. Good job there. And this is where we've seen a lot of the strength in 2023 is the mega caps. They're the ones that are really driving the indexes higher. There's a lot of AI buzz going on right now. There were some things that happened where OpenAI let somebody go. Microsoft picked them up. That really gave some support to the tech sector. There was a bond auction that was carried out during Monday's session, and that was well received. So that helped interest rates go down, which helped push stocks up. And there's more in a broad sense. When we take the whole month of November together, there's positive seasonality. Now, there are pockets of weakness as we chop our way through the month, but November and then going into December tend to be quite positive. Oil was up, and it doesn't seem to be having as much impact as it did before. It closed at 77.84. Our list in the short term is pretty long. We have the 20-period exponential moving average, the Stochk RSI, Williams percent R, CCI 14 and 20, the stochastics, the RSI 9, the boom indicator, and the slope oscillator. This hasn't changed. There's really nothing that has been added or taken away here. We see a few more things being added in the intermediate term, things that weren't there before that are now. The BP, the balance of power, and the CMB composite, those have been there. The Connors RSI, that's a new one. We don't get a lot of signals from that. And another new one is the rate of change going back 20 periods. If you remember, as we were going higher, we had the rate of change on 5 periods. That was extreme. That's fallen off. Then we got to 10 periods. That's fallen off. Now we're going to 20 periods, and that's falling off. The next one that we'll be keeping an eye on, that I calculate anyway, is the 50-period rate of change. The PMO studies, the money flow index, the vortex, which is still, it's coming down just a little bit, but we're wondering that green line is getting pretty high there. Another one is the Sean trend meter. That's a new one to the list. It had been turning more positive. Now it's starting to look extreme. The ultimate oscillator, which gave us an extreme reading a while back, dropped down. Now it's going back up. The RSI 14, that's another new addition to the list. The TTM squeeze, the S&P 500 McClellan oscillator, and the bullish percent index for the NASDAQ 100. And we're still working through this same basic scenario. The economy seems to be in a decent spot right now as far as the stock market is concerned. Not too hot, not too cold. We're going with the idea that the Fed already told us that they're going to keep rates higher for longer, and the market seems to be digesting that. The idea now is, are they done raising interest rates? And as of this point, the market is pretty much convinced that they will not be raising rates even more. The market may be developing this idea that in the future they will cut rates, but we're not hearing any kind of talk about that yet coming out of the Fed. We will still keep an eye on the Israeli war that's going on. We'll keep an eye on oil and then earnings as they are released. NVIDIA is going to be reporting after the close on Tuesday. That could have a real impact on the tech sector. The dollar was up and interest rates were down. The dollar going up may have provided some headwinds, but interest rates, and they weren't down all that much, so they didn't have much of an impact. We have the 10 to the 5, the 10 to the 2-year, and the 10 to the 3-month yield curves, which are still inverted. Sentiment is getting more positive now. We closed after Friday at 58. After Monday, we ticked up to 62. We're not getting to an extreme reading yet, so we can go with this. And this is that whole broad area of sentiment. We're trying to figure out when the market gets extremely happy or extremely sad about things. That's when we look at contrary things beginning to happen. As we're moving in one direction or the other, right now we're moving up, we can go with that. We can roll with it and just take advantage of it, because that's what we're seeing the smart money doing. That's what we see our charts doing. But then we get to that point where we've gone too extreme to one side, and then that's when we look for some sideways consolidation or in fact some kind of a pullback. Our trend is still positive. I haven't changed anything on here. The ADX is strengthening. It's above its moving average, and the green line is on top. Our bias and momentum continue to be positive. The economic reports that came out, we just had one, the leading indicators, or LEI, if you want to use the acronym. It was down 0.8%, a little bit more than the down 0.7% they had expected. Last time it was down 0.7%. And here's a chart, and this comes from Yardeni Research, Edward Yardeni, an economist that I tend to pay attention to, where the red line is the leading indicator, and that tends to be a little bit more active here, and it has been declining. The coincident, that's more of how are things being impacted right now, and that's the blue line, and that continues to go up, and that is seeing more potential strength. So we're seeing a little bit of a discrepancy between these two charts. Then we did close down a little bit with the 10-year yield at 4.42%. That's still above the 4.02%, which could be biting into corporate profits. Here's our intraday chart where we did have a higher open. There wasn't much of a gap, but because Friday's session was so narrow, we got up to R1 and R2 pretty quickly, and then we shot up to R3, which I had to add on the chart. We got a little bit above that and then ended up closing down below it. Here's the intraday chart. When the futures started trading Sunday afternoon or evening, we were up initially. We actually went negative for a little while, but then the real strength of the market didn't come from the futures. It came from what we saw in the cash session during Monday, on Monday. And then we're a little bit more positive now going into the initial overnight session. Here's the growth of value chart where they're pretty much the same. They were both positive, and the blue line and the red line are kind of on top of each other. And we're seeing a little bit of an improvement here with our growth to value ratio on the intraday chart where we were positive. So growth did slightly outperform value. The end of day charts, here we look at growth outperforming value with the large caps. They were about even with the mid caps, and small cap growth did outperform small cap value. We're still looking at the mid cap growth to value ratio because that is continuing to hold up fairly well. The small caps, it's chopping sideways. And the S&P, it's a little bit of a concern, but we're getting a little bit more strength here from the mid-cap ratio. Here is the end of day where we ticked up for the S&P 500 growth to value ratio. So it's showing a bit of an improvement, but again, we want to see this really going up to give us more confidence in the market. We are looking at this growth to value ratio, which is breaking out and showing some improvement. So that can give us a little bit more confidence here. Looking at the condition of our trend, we haven't really changed. We're just continuing on with what was already there. The ADX is above its moving average. That's the black line above this lighter line. And the green line's on top. Everything is above 20. So that suggests we're in a strengthening trend, and that trend is positive. And we're seeing pretty much that same thing in the short term. One thing to be aware of, we're kind of starting to get extreme with the green line here. Now we can go above that, but sometimes that can tend to point out some kind of exhaustion. I mainly look at the ADX and where it is, if it's above 20 or it goes above this line. But we also want to keep an eye on the colored lines as well, especially in this case, the green line, because that can sometimes signal exhaustion or a reversal before it ends up happening. Volume is dropping off, and on the average basis, we're starting to drop below the midpoint. Keeping an eye on sentiment, and again, this is what we look at to see how is the market feeling. If they're feeling positive, then we're tending to feel positive. And if they're feeling negative, then we're more negative. It's just when they get, oh, the market's just going to magically go up and it's never coming down again. That's when we start to look at taking the opposite view. And then we have a number of charts that help us measure that. This is the average from 1990 to 2022 for the VIX. I moved this circle down a little bit because we're working our way through November. This might be this period of time where we do see the VIX continuing to decline, which is what we're seeing as it's being played out. The Ulcer Index, which is another sentiment gauge, it's really dropping down, suggesting there's not a lot of fear. That means there could be some complacency in the market. Here is the VIX, where it's dropping down based on the line chart as well as the bar chart. And if you want to learn more about this, I would really recommend the classes that I take. I really break down the VIX. And my assumption, and I know it's a bad thing to assume things if you're familiar with that joke, but I can't sit here and really explain all the intricate details of any of all these indicators. I do that in my classes, and then my assumption, that's where you make the assumption, is that you've taken the classes, and so when you look at these charts, you know the logic and how these things are created and how I put them together, because these videos are long enough as it is, and if I had to stop and teach every little point all the time, these videos would be just, I'd be soaking up too much of your time every day. So that's why I just tend to mention these things, because I have a two-part program. The classes teach you the theory and the basics. This is the real-life application of the theory and the basics that you learn in the classes. I hope that makes sense. And I may be opening up the classes again at the beginning of 2024. So if you're interested in that, just keep an eye open for more information about that. Okay, looking back at the VIX here, we're declining with the line chart. That's the closing value. And then the bar chart, that's the spread from the high to the low throughout the day. And we are really declining with this, showing there's not an awful lot of fear. The VIX of the VIX measures how fast or slow the VIX is actually moving. This is dropping down as we've been going up. Here's the VIX to VVIX ratio, which is now looking a little more convincing as it's turning down, and that's positive. Here's the VIX to the 3-month average of the VIX, which is also starting to go down. That is positive. Then the VIX to move ratio is also declining, meaning that stocks are showing less volatility than bonds. And the SKU index, I brought this out in Monday's video because we were getting an extreme reading. We've now dropped down below that, and we went up from here. So this was one of those times when the SKU was expecting some kind of a move, and that ended up being to the upside. This has not been updated yet. I waited and waited for these charts to update, so this is probably out of date right now. The equity put call ratio, it's just not getting to me in a very timely manner. We can assume, of course, that's dangerous, but this probably declined because we had an up day. So when we look at the 5-period simple moving average, we can assume that this is continuing to decline. That's positive. And here's a longer term look, and we can assume that's declining as well. The longer term, it's still trying to roll over, but again, it's going to take some time for this to actually turn and start to go down in a convincing way. Here's another fear gauge where we're seeing this continuing to decline as well as fears coming out of the market, and it's still another fear gauge. Tick down just a little bit here, also suggesting that fear isn't really that strong right now. We're seeing some improvement with the risk on to risk off ratio. It is starting to come back up. We want to keep going up before I can actually put a blue line in here and say, oh, look at this. This is actually showing some more strength other than just some improvement. Our advanced decline line, we're showing a lot of improvement here based on price and volume. We're above the moving average and going up. In our new highs, new lows study, we did see a bit of a pickup in the new highs. We're rolling over a bit with the 5 period. We're starting to turn back up after flattening out with the 10 period, but this is showing some improvement as well. The advanced decline ratio, both the blue line and the red line are above 0 and advancing. Accumulation distribution is above an advancing moving average. That's positive. Jake and money flow, which really spiked up on Friday, it spiked up again after Monday. That's another smart money indicator and is showing a lot of improvement. Looking at the NYSE cumulative advanced decline line, we're coming right back up to this trend line now. I actually went ahead and extended this. In our regular advanced decline line, we are showing some improvement as we're breaking above this declining moving average and breaking above the moving average. Breaking above this downward sloping trend line and breaking above the moving average. We're also seeing some improvement here with our other NYSE advanced decline line. We're starting to break above this moving average, but we're still working off of a recent death cross with the trend of the NYSE advanced decline line. I haven't shown this in a little while, and I pointed this out over the weekend in the deep dive video. We're seeing a bit of a divergence here, and it's kind of unsure right now whether this is positive or negative. We have the NYSE common stock advanced decline line. That's not breaking out above this previous high. But if you look down based on volume, we are breaking out over this previous high. Is that positive? Is that negative? You could take a side either way. Right now, I would suggest it's more positive because it's nice when volume tends to lead price. And that means we're seeing more buying than selling, even though it's not necessarily being reflected in the prices. Here's our advanced decline line studies. We're showing some improvement with the NYSE common stock, the S&P, and the mid caps. We're trying to get above the moving average with the small caps. And as I'm thinking about it, there was a request that I do some kind of a breakdown with the small caps, which is beyond what I do. Because the market is closed on Thursday, if I get some time, I may try to do a little supplemental video that focuses more on small caps. Everything that I do is about the S&P 500, and everything just ties into that. But if I do get some extra time, I'll try to put together a video about that. Our short-term analysis, we finally were able to break above this pivot point. And so this had been some overhead resistance. The fact that we could get above that is positive, but on the bottom, you see where we dropped to below average with volume. The 20-period exponential moving average is looking rather extreme right now. It could still go higher. The 50-period is positive, and the 200-period is turning up and looking more positive. Then our short-term indicators, the Stochc RSI is extreme, as is the Williams percent R, the CCI 14, and the CCI 20. The force index is not extreme. It's still positive. It came up to this Keltner band, dropped back, and is starting to go back up, but is not extreme right now. But when we look at our stochastics, we're extreme in the short, intermediate, and long-term versions on this chart. We are looking extreme with our standard deviations chart. We were at the upper end of this +3 standard deviation. Now we've actually closed up out of that. The boom indicator based on 20 periods is extreme positive. We're not extreme with the 50 and showing some improvement right now. We're also looking more positive with the 200 period study. And what this chart tries to do is how far away are we either above or below a moving average, because price tends to not get very far away before it snaps back to that moving average. Intermediate term charts, the balance of power is still extreme. We're still extreme with the CMB composite. The go, no-go system is still positive. The highest high value is still starting to break out here, but the blue line hasn't really picked up yet, and the midpoint is now going up. The Connors RSI just barely getting above this level. right here, which suggests we're extreme positive. The TTM squeeze continues to go up and is getting even more extreme. And here's a longer term look at that same chart. The other time we got about up to this level was in the spring of 2022, and that ended up marking a top once this finally topped out and started to come down. Is that going to be what happens this time? We don't know. The ease of movement is turning back up and is above zero. That's positive. The Erin continues to show some improvement. Here's the 20-period rate of change. We're starting to get an extreme positive reading because it's going all the way back now and picking up price since the low, and it's going, wait a minute, this is pretty far, pretty fast. It doesn't necessarily mark a top or a bottom. Sometimes it does. Sometimes it just marks a slowdown with things, but this week is just something we want to be aware of. Here's the S&P 500 McClellan oscillator, which is still extreme positive and still could go higher. The summation index based on price and volume are advancing and both are above zero. The NYSE summation index is advancing based on price and volume as well. The Swenlin trading oscillator is looking more positive based on price and volume and not extreme. On a momentum basis, the PMO is going higher, and we're also going higher based on price and volume. We're extreme with the PMOs that are rising and the buy signals, where we're still positive with the PMOs above zero. We didn't really get that big of a move to switch us back over to positive with the Elders Impulse system, so we still remain neutral. The parabolic SAR, though, continues to be positive with the dots underneath. The slope continues to go up and could be getting to an extreme reading. The MACD is looking more positive, and I actually have an additional chart. I showed this in the weekly video, but we hadn't quite crossed over yet. This is a weekly chart of the S&P and then a weekly chart of the MACD. This is suggesting if we can hang on to this, because this chart won't complete until Friday, after Friday's session. But if we can get back above this moving average and stay above it, that would turn us more longer term positive in the with our momentum. So looking at our daily chart of the momentum, we're getting kind of extreme with the slope, but we're still positive with the TSI. All of our intermediate term oscillators and our long-term oscillators continue to be positive. The Sean trend meter is ticking a little bit above this red line. That means it's getting extreme positive. We're above all of the plotted moving averages in the moving average tree. The bullish percent index continues just to chomp its way a little bit higher. That's positive. And the NYSE bullish percent index is showing some improvement, but we're still below 50. If we could cross above 50, that would really show that the broader market is turning more positive as well. Then with the NASDAQ 100 bullish percent index, we're flattening out here above 70. That's giving us an extreme positive reading. The Chaikin oscillator is turning back up and is looking positive. The money flow is still extreme positive. The ultimate oscillator is now giving us another extreme positive reading. The vortex, the green line is coming down a bit, but we're still looking rather extreme. This is positive, but it's kind of interesting that this actually ended up coming down on an up day. The RSI based on 14 periods is just barely crossing above 70. That's a new signal, where the RSI 9 period has actually been extreme for a few days. On balance, volume is looking more positive. We're showing improvement with the 200 period moving average, 200 period moving average study for the S&P, and an improvement with the 50 period moving average study. The Copic curve continues to be positive. Longer term, we could be getting to an extreme reading here when we compare it to other times. Pring bottom fissure is still looking positive, even though it's rolling over just a little bit. And I don't have any Fibonacci charts, but I did add another chart here to the trendline study where we came up and closed right about at this previous high. We got above it on an intraday basis, but we haven't really been able to close above that yet. That could be acting as overhead resistance. If we can get above this and close above this level, that would exceed the July 31st high, and that would make things look even more positive. Our different charts, we're positive across the board. So our Heiken Ashi, the Kegi chart, the Renko chart, the 3-line break chart are all positive. We did get a new X drawn in here with the point and figure chart. That's positive as well. We had a new signal, which is a double top breakout. Our long-term charts, we are still suggesting that the market thinks anyway that we're going to head towards a soft landing, which means that we're seeing economic slowdown without necessarily going into a recession. And That had been the prevailing attitude earlier in 2023. Over the summer, that attitude started to go away. Now that attitude is starting to come back. Also looking at our longer-term weekly chart, we're well above the trend line going back to 2009. The equal weight is showing some improvement when compared to the S&P, but it's still underperforming in a broader sense. The equal weight did tick back, the mega caps tick back up just a little bit when compared to the equal weight index, and that's where a lot of the strength has been coming from. Looking at Dow theory, we were up with the Dow, the transports, the utilities were actually down slightly, but the transports are still underperforming the Dow. And we're coming down just a little bit here with the transports. We want to see this really start to decline. That's when the transports are outperforming. This, we want to see the ratio going up. That would show that the transports are outperforming the S&P. It's not really happening yet. That's one warning sign. The Dow was able to break above this R2 level, this pivot point, which we know about before it even happens. These are drawn on the chart and just stay there for long periods of time. This had been providing overhead resistance. We were able to get above that. We've also been able to avoid a death cross with the Dow. The diamonds still remain neutral, though. The NASDAQ is still dealing with this R2 level, so that might be something to watch. If we start going up in Tuesday's session, can the NASDAQ get above this 14,200? It's really hard to read. Look at the 14,200 level just to kind of get a round number. Then we're still above the 61.8% retracement level. If we keep going up, I'll stop showing this chart. If we start to fall, we'll be watching this for support. The NASDAQ 100, this is positive. It was able to break above this R2 level. The NASDAQ is a broader measure, where the NASDAQ 100 is a more narrow measure. These are the stronger stocks. And if this can continue to go up, it might pull the NASDAQ up with it, which would help things look a lot more positive. But we still remain neutral with the QQQs. The NASDAQ 100 momentum continues to be positive. The small caps, doing okay. They were up less than 0.5%, but they have not been able to get back above their 200-day moving average yet. And the Russell 2000 is showing some improvement with the RSI. We do have a longer-term death cross. On a momentum basis, shorter term, we are remaining positive. The small caps have switched, or they remain positive here with the Elders Impulse system. The mid caps were able to get back above their 200-day moving average. That's positive. Now, can they keep going, or are they going to start to give this back? But when you look at the Elders Impulse system, we have switched from being positive to neutral on an up day, which go figure. The financial sector is now starting to generate a golden cross. We stayed above the 50 and 200-day moving averages long enough for this to just barely start to turn back up. The microcaps are still dealing with the 100 level, and actually we're able to close above that. That's positive. The FANG index was up 1.5% and continues to have a pretty healthy looking chart pattern here with a series of higher highs and higher lows. They're above their 50-day moving average and still in a longer term uptrend. And we're coming back and testing this previous all-time high here. Can we break out and set, at least on an intraday basis, even improve on that? And then when we look at the Qs and measure it with the 3 to 7 year bond ETF, the Qs are really outperforming bonds. The tech sector continues to outperform bonds as well. The dollar was up just slightly. It's still in a longer term uptrend. It got hit pretty hard last week. Now it may be just bouncing back up slightly. Keeping an eye on bonds, we were down slightly with the 10-year yield, and we were up slightly based on price, but we've been chopping sideways more or less for the last few days. And this is something that I pointed out in Monday's video. When we take the 1-month yield and subtract the 3-month yield, we got a negative result. Now we got a positive result, which we shouldn't be getting. Now we're back to actually getting a negative result. And we look at bonds to stocks, showing that bonds are now continuing to underperform stocks. An update of some of our possible positive scenario charts. We're showing some improvement with the Qs to S&P. Not a lot of improvement with discretionary to the S&P. We want to see some strength there. Large cap growth versus large cap value is still holding up okay. So with the large caps, we're looking pretty strong, showing a little bit of an improvement with the mid caps as well as the small caps. The 10-day average of the S&P 500 highs minus the lows, we're still getting to a high reading without necessarily being extreme. This is something that's also positive. This has been negative for a long time when we look at the highs minus the lows for the Amex, NASDAQ, and NYSE, and then take a 5-period moving average of that. We finally, for the first time now, have been able to cross over positive. We're also crossing over positive with our 50-period moving average study of the new highs, new lows. That is longer term positive because the black line continues to be above zero. That's pulling the red line, which is the moving average, back up positive. The 2-year treasury yield, wondering, have we spiked and are starting to come down? We don't really know that yet. If that continues to fall with the 2-year yield, that could give some additional support to the S&P. The S&P to utilities ratio has been chopping around a lot lately, but it has been going up overall. That can be positive for the S&P. And the staples have been declining in this ratio. That's also positive for the S&P. When we look at the 19-day exponential moving average of the advanced decline ratio, we're still looking positive based on price and volume. And then the Tom Bowley research, and we have to kind of figure out, are we still in the negative time, or now are we starting to come more into the positive time in November based on his research? So what's our outlook for Tuesday? We are dealing with earnings, as well as NVIDIA will be reporting after the close on Tuesday. That could be a big influential thing for Wednesday's session. We're still worried about this whole geopolitical thing going on. The technicals are positive, but they're still overbought. Haven't changed that because we continue to go up. We will get existing home sales, and then at 2 p.m. Eastern time, that's when the FOMC meeting minutes will be released. And then keeping an eye on all the different geopolitical events. Here's the economic calendar. On Wednesday, this will be the long list for the week. Some things that usually come out on Thursday will be coming out on Wednesday, like weekly jobless claims. We're going to get durable goods and consumer sentiment. Please keep in mind also that the market will be closed on Thursday. There won't be any economic reports on Friday, but the market will be open for an abbreviated session. Here's the Stock Traders Almanac statistics, which are exactly the same for Tuesday that they were for Monday. We're negative with the Dow. We're neutral to negative with the S&P. We're neutral to positive with the with the NASDAQ. And we're now into the week after options expiration, where we tend to be up more than down. We will be on the 15th trading day of the month. We're during a pre-election year. Sometimes we see some weakness when we look at the green dashed line. But when we take the whole month of November together, we tend to look positive during a pre-election year when the current president is running for re-election. We're also seeing positive seasonality on this chart, as well as this other chart. And this other chart that suggests that during a pre-election year, we tend to see positive results, which is true, but we don't necessarily outperform the other years. And then here's another newer chart put out by Carson, where maybe we see some weakness in the earlier part of December before seeing some more positive seasonality going into the end of the year. When we look at the Stock Traders Almanac chart, we're still wondering, are we going to be coming down a bit here with the NASDAQ? They historically see some weakness during this time. We also see some weakness during this time for the S&P. So our scenarios, we're not going with the down one. There's really no justification for even considering going down right now unless you're ultra aggressive with things. But we've got positive seasonality. All of our charts are looking good. There's really nothing on the table right now to suggest that things could go down. At least there's no confirmation of that at this point. Of course, that could change at any time. But we are overbought right now, but it doesn't seem to really matter. Now, there might come to the point where the market is saying, wait a minute, we're due for a pullback here. We've been going up pretty strong. We're just not seeing that yet. So if anything, we're still going with the positive scenario. We're not going with the sideways scenario because our ADX indicators suggest we are in a trend, and that trend is positive. The warning signs, we still have our longer period equity put call ratio that's going up. The risk on posture, it's still in the longer term showing some weakness, but it has been showing a few days of improvements there. The Russell, the small caps, and the mid caps have generated recent death crosses. Then when we look at the positive signs, the daily special K chart is now switching over positive. I'm not going to show that for a while now unless things actually start to change. The weekly chart is still negative, and I covered that in the weekly video. On a momentum basis for the S&P 500 and NASDAQ 100, we are still positive. The equity put call ratio based on 5 periods is going down. The parabolic and the vortex indicator, they're both positive. The bullish percent index is above 50 and advancing and not necessarily extreme yet. Small and mid-cap growth, especially mid-cap growth, is looking more positive than small-cap growth, but both of them are still positive together. This is a new one. The financial sector has generated a golden cross. And this is another new one. The 50-period moving average study that we do with the new highs, new lows, it's crossing back above zero and turning positive. So our conclusion, we're positive but overbought. Haven't changed this. We can say that in the short and intermediate term, and we're still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.